All right, let's dive right into this explainer on the macro strategist David Hunter. He has a really bold and, to put it mildly, very contrarian market thesis. We're talking about a massive rally that's then followed by an even bigger bust.
And, Hunter himself basically sets the stage by saying that in his entire 50-plus year career, he's never seen an environment like this one. It's this core belief that we are in truly abnormal times that really underpins his whole extraordinary forecast for what's coming next. So let's kick things off with the prediction that gets all the attention. This is the heart of his short-term outlook, a final, absolutely explosive rally that he calls the blow-off top.
Yep, that's the number, 9,500. That is his target for the S&P 500. And we're not talking a few years from now. He thinks this could happen by this summer. I mean, that's a staggering 40 to 50% rally from where we are now in a very, very short period of time.
Okay, so the big question is, how on earth do we get there? What's really fascinating about Hunter's thesis is how all the pieces connect. It's like a chain reaction, and it all starts with one crucial element that really goes against what most people are thinking right now.
So how does he build the case for this massive rally? Well, the entire thing, from stocks to precious metals, it all rests on one single foundation, a rapidly, and I mean rapidly, weakening US dollar. If that doesn't happen, the rest of the forecast just falls apart.
He sees a pretty clear sequence of events here. First, US bond yields start to fall. At the exact same time, yields in places like Japan and Europe are actually rising. So what does that do? It shrinks the rate differential, which basically makes holding the dollar way less attractive, causing it to weaken significantly.
And this is where you can really see just how contrarian his position is. I mean, the dominant narrative everywhere has been higher for longer rates, right? Well, Hunter is calling for the exact opposite. He's predicting a sharp drop in the 10-year Treasury yield all the way down to 3% by Labor Day. And on top of those interest rate dynamics, he also points to these bigger, more fundamental long-term problems that are weighing on the dollar. You've got the sheer size of the US debt, the long-term impact of all the money printing, and of course, the growing global chatter around de-dollarization. So if you have a falling dollar acting as the fuel, where does that fire get lit first? Let's look at the first major pillar of his predicted rally, precious metals. Because historically, a weaker dollar is incredibly bullish for anything priced in dollars, especially gold and silver. Now, given what we've seen so far, you can probably guess that his gold target is going to be just as audacious as his stock market call. It really reflects that same kind of parabolic, explosive thinking. He is forecasting gold to more than double, hitting $6,800 an ounce. And again, he thinks it could happen as soon as this summer, just propelled by that falling dollar. But there's a second key driver he identifies, and that's a flood of new money. He argues that as these huge institutions are forced to chase performance, their massive amounts of capital are going to overwhelm the relatively tiny metals markets. It's like trying to force a fire hose of water through a garden hose. The price just has to launch vertically. And if you think the gold price target is wild, he expects an even more dramatic, leveraged return from the mining stocks. I mean, just look at these targets for the ETFs. He's calling for GDX, the big gold miners, to go to $180, and GDXJ, the juniors, to hit $250. These are moves that are many, many multiples of their current prices. All right, now for that second pillar. Let's tie all of this back to his headline-grabbing forecast for the stock market itself and see exactly how he justifies such a massive move. And what's really crucial to understand here is that this isn't just an S&P 500 story. He sees a really broad-based melt-up. We're talking the S&P at 9,500, the Nasdaq hitting 32,000, and the Dow Jones reaching an absolutely incredible 65,000. Now, he argues this rally won't just be pure fantasy or euphoria. He thinks it'll actually be rationalized in the moment by a few things. Some surprisingly strong corporate earnings, a huge tailwind from those falling bond yields we just talked about, and one other, kind of paradoxical force. And that force is what's known as the wall of worry. Hunter believes that big institutional investors are still really skeptical. They've got one foot out the door. And it's precisely that widespread pessimism that acts as fuel, because it prevents the market from getting too frothy too fast and actually allows it to keep climbing higher and higher. But here's the thing. A blow-off top implies a peak,
right? An endpoint. And for Hunter, what comes after this final parabolic rally is just as important and, frankly, far more severe.
He is absolutely adamant that this isn't just a normal cyclical correction. He sees this rally as the grand finale of a 43-year supercycle bull market. And the bust that follows, he warns, is going to be global and it's going to be systemic.
And in this bust phase, he's anticipating a massive deflationary collapse. He sees oil prices just plummeting to $30 a barrel, maybe even lower. And that 10-year US Treasury yield we talked about earlier, he sees it falling all the way to zero.
You know, Hunter is totally aware of how far his views are from the mainstream. He gets it. And this self-awareness, it's really central to who he is, and it directly informs the advice he gives for how to navigate this incredibly volatile period he sees coming.
And here's his key piece of advice. He warns against trying to be a hero and cashing out too early. Think about it. If he's right about another 40% rally from here, he argues that the psychological pain, the FOMO, of missing that will force most people to chase the market and get back in at the absolute top right before the bust.
And that really leaves us with the central question his entire thesis poses. In a time that already feels historic and is full of extremes, could it be that the most unconventional, the most contrarian outlook is actually the one that ends up being right?